Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's podcast conversation. I'm super excited to have with me Jackie Kennedy, who is the Chief Operating Officer at Quicknode. Quicknode is a Web3 infrastructure company, and we'll talk about the developments in the space as well as what it's like to build for developers and for this growing ecosystem. Jackie, welcome to the podcast.
Thank you so much, Lex. I'm so thrilled to be here.
I'm really excited to learn from you as well. So my first question is about your background and how you came into entrepreneurship and technology. I noticed that you started in the law, and I spent some time at law school as well. And it's often a windy road towards entrepreneurship, technology, and especially crypto. Can you tell us what your experience was like in those early days and sort of what was your journey?
Yeah, absolutely. Well, going into law school, I kind of knew that thinking analytically and reading comprehension was pretty strong for myself. And so I figured this would be great. I can help deals get done. I can maybe focus on transactional work. The first summer role that I had at a law firm, I instantly realized, oh my God, what did I do? And so, like a lot of lawyers that go through law school that instantly realize maybe this isn't for them, you almost take this really weird, windy, non-linear path to kind of where you want to end up. So in law school, I ended up taking a bunch of MBA classes, entrepreneurial finance, strategic finance, and got pretty involved in venture capital and the startup ecosystem in Boston. That's really where it started. And then I realized the juxtaposition between law and what I was studying and what I was summaring to do was very much not what I wanted to do. And so law really focuses on conflict and essentially sometimes tearing things down or even risk. And what I wanted to do was kind of do the opposite. I wanted to build. I wanted to create things. I didn't want to poke holes or identify risk in, a 20-page document. I wanted to say, okay, what does this actually mean? How can we actually build this and see through the horizon? And so it really brought me kind of to the startup land. And so I kind of just did everything I could to immerse myself in the startup world. And so I had a venture capital fellowship in law school. I started a startup entrepreneurial clinic where lawyers can give kind of free legal advice to entrepreneurs when they're getting started. And then from there, I just kind of never looked back. I joined a pretty prominent investor for the first 2 years after law school, and then started a really small company after that to really get my hands wet. And then from there, kind of just never looked back. And so it's really interesting, Lex. I don't know if you've seen this, but a lot of my kind of cerebral friends who went to law school but don't really enjoy that confrontational aspect of law, there is almost like 95% of them are completely out of law into like new things like businesses or entrepreneurialism. So, I felt very alone doing that right out of law school. But then it only took 5-10 years after law school to see a lot of my friends who think the same way also kind of depart and go down their like non-linear path.
Yeah, I want to ask about the word risk because I think it's key to both entrepreneurship as well as understanding what the legal profession is about. And understanding what the legal profession about, I think, is really helpful for understanding what is happening from a regulatory perspective, at least in the US. But, this idea of, you mentioned looking at a deal and figuring out ways to circumscribe risk. What does risk mean from that point of view? And then alternately, as an entrepreneur, when you take on risk and you de-risk things, what does it mean from the entrepreneurial side?
Well, I think answering your last question first, the entrepreneur, you have to have rose colored glasses, right? Like you're not scared of risk, right? If you're saying, I'm going to leave my full time job that's cushy and comfortable and go, with maybe zero salary the first 6 months, take a lot of risk because you really believe in a world that will change based on your company. And so I would say when you're an entrepreneur, you're not risk averse, right? You're wanting to take those big leaps and challenge yourself and really see what the world will look like with your new product or company. I think in law, you're trained to look at a deal, for example, and say, here are the 15 to 20 ways it could go south. Let's solve for each one of them and try to come up with a solution that will de-risk that issue. And so, it's to me, it was kind of exhausting, always thinking about what bad could happen instead of, well, what would this look like if this deal came to fruition? What would the world look like? And I think that's really the difference between the entrepreneur mindset and like a lawyer's mindset.
My learning around the entrepreneurial journey is that actually entrepreneurs can actually be really conservative in their risk appetite, but it is that they take the risk on and then they chop it up into bits and get rid of it. So like you're not like, oh, hey, I'm going to start a new company and do all of the things that expose me to completely wild, fluctuation. It's like, okay, I have a new thing I'm doing. How can I lower my go-to-market risk, lower my product risk, get rid of my cybersecurity risk? And you're trying to take action to change it instead of saying, okay, well, it looks like there's some risk there. I can't go next to it because it's so icky.
Yeah. I mean, I think even each stage of the startup across industries are all around risk, right? The pre-seed angel round is all about, will customers pay for this, right? Is there demand? Is there a market? And then you go to seed, it's like, okay, what is the willingness of the customers to pay over time? And then you get into product market fit, right? Is this scalable? And then you get into later rounds, like, is this a fundamental business with great unit economics that can be a long-term business? And so all those things are risks that each entrepreneur kind of goes in their own stage across, industries. So I totally agree with you, Lex. It's bite-sized risk in kind of thematic ways based on the stage as well.
You transitioned into Startup Land, and then you spent a bit of time in large infrastructure companies like DigitalOcean and Amazon. Can you talk about maybe just even the posture of infrastructure companies towards their customers? Like, how do these companies think about builders and developers? How do they think about providing services to them? Like, what are some of the organizing principles around that before we get into Quicknode?
Yeah. I mean, infrastructure is so sexy, isn't it? And exciting. But what I loved about it and what I didn't like about law and what I liked about starting companies, investing in companies is it gives the tools for builders to build, right? You don't have to spin up a server in your garage and then have 10 servers when you want to scale and have $1 million just so you can have 100 customers based on the hardware requirements to scale. And so I saw this beautiful change when cloud computing was really taking off, where we're helping builders build, and that's what really I got excited about. So yeah, I started really in cloud infrastructure at DigitalOcean. And for people who are unaware of DigitalOcean, it's really, when I joined, was cloud computing made easy. We had a product called the Droplet, and it basically made anyone to spin up compute in like less than 60 seconds. And so anyone who wanted to learn how to build or create or even just like work on a project, they could do it within 60 seconds. And so that got me really excited. And so I stayed at DigitalOcean. I think I joined pre-Series B or right around Series B. And then I stayed for, I believe, 3.5 years and saw this insane growth from, 110 employees to, I think when I left, we were like 550. And so I would call it like hyper scale. A lot of fires, everything was breaking, but we were still building and growing, and customers were really loving us. And when developers were crossing the chasm into cloud, they would start with us. And so we really saw, we were the front lines of developers building in the web. And I think it was a really awesome experience.
Do you have any learnings or memories of like developer personas? Like what kinds of developers were there that were engaging with cloud? And maybe were there any particular dynamics for how you would go to market towards them?
Yeah. Well, DigitalOcean, we were really focused on community and education. So let's give kind of these early developers or part-time developers all the tools and education and community they needed to really understand how to build and make it really easy for them. We assumed that the developer persona at that time, which was like 7, 8 years ago at this point, maybe even 9, I don't even know how old I am right now, Lex, and give them the tools to really understand how to build quickly. And so the persona was kind of early developers in their lives, in their adventure into cloud and building. They might have had about 3 to 5 years of engineering experience. We didn't really work with enterprises, so it was really developer focused. These developers were building part-time projects or personal projects. We had a lot of early stage startup customers. We had a program that I ran called Hatch, which was our startup program, and we had a lot of great pre-seed, idea stage startup entrepreneurs coming to DigitalOcean just because it was so easy to build. You didn't have to worry about infrastructure. You didn't have to go to AWS or GCP and understand, the 300 products they have and how that relates to their business. They came to DigitalOcean because it was so easy to build. And so the personas were, early developers. We had a lot of startups. We had a lot of students. And we also had a lot of very small agencies that worked building websites, building really small applications for their customers.
Was there ever a moment where it was like, actually, there's not enough developers who are going to move into cloud? Or was it always really obvious that, how people build software will use the cloud?
Yeah, I don't think so at the time. Honestly, the market wins were so strong, like in 2017, 2016. I mean, it was so compelling. It's a lot stronger. I think we see developer adoption probably 2 to 3x stronger than Web3 right now, just because it's a little bit more mature. And so I don't think we necessarily questioned the market and developers adopting. I think it was more along the lines of, well, what are they going to need in their life cycle journey, right? Are they going to need specific networking tools? What can we provide that still makes it easy? And you probably know this, Lex, but when you go from one product to 5 products to 20 products, simplicity at the core is so challenging. And so we had to have this balance of helping developers, but also staying really easy to use. And that's actually really hard. It sounds so simple when I say it, but it is really challenging. And so I would say that was a challenge. And then, of course, when you focus on developers, they're not signing 3-year long-term locked-in contracts and are, price insensitive. So, what we saw with developers is there's most likely higher churn than normal, higher turnover. They're a little bit harder to market to in advertising. So it had its own inherent challenges, but I don't think we questioned whether the developer growth was going to grow at the rate we thought. If anything, it surpassed it.
That gets us to Quicknode. Let's start with just understanding what is Quicknode, what is it for, how does it work, and then a little bit about your journey towards the company.
We make blockchain development really easy for developers and enterprises. And the way we do that is we basically offer infrastructure for anyone who wants to read or write to, I think we have 17 now, chains. And so it's very similar to, I would say, Web 2 architecture. But instead of needing kind of all these backend systems, you just write to chain and you read to chain. And so we basically give you access to a node in order to do that. and all these other tools. And so we've indexed a lot of data, and we can provide very clear data on NFT transactions, NFT volume, all the way through token data. And so our kind of platform is now this really holistic platform that has SDKs and content and really helpful guides for Web3 developers to kind of spin up their dApp or their decentralized application.
And how did you join the company?
I wore a lot of different hats at DigitalOcean. Consistently always reported to the CTO and then the COO, and really close to the founders. Actually, the founders of Quicknode are very close to the founders of DigitalOcean. And I was introduced by the founder of DO, Ben Uretsky, to the founders of Quicknode when I was at AWS. They were applying to Y Combinator, and I was really close to the YC team at the time. And so I kind of took the call, helped them with their application, helped them with their YC interview, and then invested a very small amount of money at that time. And then they went through YC, and then I just had this really gorgeous perspective where I got to watch them grow in 2020. And I believe their growth was like 15x in that year. It was just so mind-boggling how fast they were growing. And so, like most people in the Great Resignation, I too left, my big tech company job and decided to come join Quicknode kind of a little earlier, but the same stage as DigitalOcean. I mean, I see so many parallels between the challenges DigitalOcean faced and the challenges that Quicknode, currently or were facing. And so that got me so excited, taking my 9 years of infrastructure, bringing it to Quicknode, and helping them really solve the operational efficiencies and the operational challenges that we saw and help them scale. And so that was really my genesis story of getting involved with Quicknode.
Really interesting. And the questions I start having are about what kind of things you're able to see based on developer usage and developer interest. So maybe one place to kind of start is just revisit that persona question of, what kind of people or what kind of personas are you seeing now in the market dealing with Web3 infrastructure? I'm also interested in kind of the difference by product, but maybe we just start with like who's showing up, is it, and I'll be sort of rhetorically controversial, right? Is it just the 14-year-olds trading monkey apes or like, the North Korean hacking group trying to break all the DeFi projects? Or is it, Goldman Sachs with a payments network? Like who's showing up and what are they trying to get done?
I will applaud any 14-year-old who's making money flipping monkey gifts. No, that's not really what we're seeing. I would say, it's very similar to what you saw in the market in 2021 and 2022. And so we did see a lot of NFT traffic. So a lot of developers minting NFT collections, trading NFTs, doing a lot of analysis on NFT transaction volume, what collections are hot. And so that was really, I would say, early 2021 when I joined. So not only traders, but also developers trying to build tools to help the NFT community. We actually acquired a company called Icy Tools that provides really in-depth NFT analytics. And so their business was just taking off because of this really strong NFT bull run. But, now that things have subsided, and I would say the hype market kind of has fallen a bit, we're seeing a lot of more serious developers build really meaningful things, whether it's in DeFi or even gaming. I think that, this hype cycle, although mildly over, we're seeing a lot more thoughtful business plans. We're seeing a lot of really great operators and founders getting into the space, like Dave Balter, for example, in Flipside Crypto, right? We're seeing really great seasoned entrepreneurs coming in using Quicknode and building their business with us. So I would say there's probably always going to be the NFT flippers out there, and they use our Icy tools analytics platform, and they can use Quicknode to build whatever bots they need to trade. But we're actually seeing some really interesting projects in the horizon being built on Quicknode. And so I would say it's a mixed bag. Another thing we're seeing is a lot of Web2 logos signing up on quicknode.com and testing the waters. I think a lot of engineers and product managers at really large Fortune 500 companies are just literally signing up for a self-service plan and seeing what they can do, right? I think there's this interesting kind of period in time in the past 8 to 10 months where a lot of these Fortune 1000s, they know they know that blockchain is here to stay, but they don't necessarily know the use cases and what it can do for them. And so we're seeing a lot of engineers, product managers, business managers from these Fortune 500 just signing up and just playing around and wanting to get on a call to just better understand what are the tools their teams can use to start their R&D initiative. So it seems like really all over the map. But I think they're more thoughtful, serious developers now working on actually really meaningful projects.
How do you think about who uses the different APIs? I have hypotheses about the different type of companies that can be built and how commercial they can be. So I wonder if you're thinking about these issues in a similar way, right? Like if somebody is spinning up software that is doing read-write transactions versus if somebody's spinning up software that is doing data pulls to populate their app, there's really different commercial outcomes from those types of clients. So I'm curious as to, of course, you're going to follow demand where demand exists, but how do you think about the different lines of business, like the core APIs into the chains versus the data products versus the kind of deeper token information products? Like, what's the difference in the clients that are using those and how do you think about them?
Yeah. Well, if I zoom out and I just look at what is Quicknode, I would put it into like three big layers. I would say the fundamental foundational layer of Quicknode is what we would call the RPC node layer. And so as you know this, and I'm not sure a lot of listeners know this, but in order to read and write from any type of chain, you need access to a node. And so we offer 17 plus chains and access to their nodes that are highly available and globally positioned. And so I would say that's, the infrastructure RPC layer. So if you just want to request a certain data point from a node, or you just want to write transactions to a specific chain, that's your bread and butter. That's where we see most developers in learning how to program in Solidity or Polygon or Ethereum, and really understanding the nuts and bolts. I think most chain documentation always starts at the RPC layer, right? It's the most basic thing to do. But then I think, as you said, for reading data, what we would call the second layer. And so that's the data platform layer, the data layer. And so I would say probably 80% of the use cases we see are really just extracting the data from our RPC layer. And so we always ask our engineering teams, all right, how do we make it even easier to digest and play around and develop with this data? And so that's where a lot of the enhanced APIs we've built come into play, because if they just want to know what wallets have bought an X NFT, you don't have to worry about kind of the nuances of reading from a node. You can just hit a simple API call and you can get that really fast. And it's cleaner, it's indexed. We also index a lot of third-party data. And so that data layer really enhances the ability to just read from the node, from our indexers that come from the node. And then I would say the last layer on top of that would just be the developer tooling layer. And so those are all the things that help you better engage with the data, better write to the nodes, and just build faster with our SDKs and a lot of great things that we're working on where developers don't have to leave our console, don't have to leave the app, can deploy smart contracts and understand like how to do it really quickly with our guides, all in-house. And so those are the three big layers that we see. And to your point about reading data, that's exactly why we've focused on these enhanced APIs a lot, because we want to make it as easy as possible for developers to be able to manipulate and develop and build from the data that comes from the nodes.
I'm curious to talk about economic models for Web3 infrastructure companies. I've looked at it from having looked at a bunch of companies from Blockdaemon to Infura to Alchemy. And I think finding a scalable commercial model or economic model in the space, it might not look like the cloud infrastructure of prior cycles. Supporting Web2 and supporting Web3 are kind of different things. And so I wonder how you think about the economic opportunity in terms of like literally pricing and generating value. Is the future kind of a SaaS model based on pricing on API calls, or especially I think Blockdaemon in this part of the industry stands out because they, while running the nodes, not only do they provide kind of an environment for people to API into software execution, but they also are pretty hands-on with, validating and staking in the different blockchains they support. And for me, I've also, I think, been an advocate of like combining the native economic models of the chains that the infrastructure provider supports. So if you're running ETH nodes for access, or if you're running Polygon or any of these other things, there are revenue pools available that are where you're not charging necessarily the developer, but instead you're plugging into some of the raw issuance of all these blockchain networks. So with that background, how do you think about where most of the economic value is? Like, what's the right commercial model for businesses like this?
It's all based on market maturity and market stage. And so where's the market right now? I think it's still really early. We've had one really large hype market last year, but now what we're seeing is, I was reading an article that said like 40% of the Fortune 100 companies are now building a decentralized application or use case of some sort within their internal business. And so until that gets closer to 70, 80%, I would say we're still in the second or third inning. So while the market grows and while while we're not at mass adoption yet, I think the revenue model is still going to be fairly similar that it is today. And I think most infrastructure providers in Web3 have very similar consumption API credit models. And so I think what you do, you either focus on RPC or you build the layers on top. And so going back to those 3 layers, that's really what we're focused on is let's build a great data platform with incredible data products that will, plug into our revenue model. And then on top of that, what kind of developer tooling or the applications that we can build to make it even easier to build there. And so I think until we see mass adoption for a lot of our customers, right? If our customers are growing, and this is very similar to what kind of is the hypothesis at AWS, right? I focused on early stage startups at AWS, and basically is, hey, we want all these high flying startups to grow and build on AWS, so they can be, our extremely large billers in 10 years, like the Airbnbs who spend, I think, between 2 to 4 million a month at AWS. And so, that's kind of where we see it too, is when they grow, we will grow. And then we will introduce new revenue streams with new products that build on top of that layer. Does that answer your question, Lex?
It does answer the question. I'm going to push a little bit more on this point, not because I disagree with you, but I think it's more of just a chip on my shoulder. So
Love those tips.
No, I've had a lot of conversations with Infura about like, you're running the nodes and the revenue's right there. I think it comes down to, or at least, so I have a finance background and I've moved into technology from a finance background via fintech and then crypto. And so the thing that to me is useful about blockchains is it's not just Bitcoin's ability to be digitally scarce, and it's not just, Ethereum or Polygon or Solana's ability to run software. It is also the financial value that travels on chain. And a lot of the early thesis for Web3 was about being the internet of value. People don't quite say that anymore, but I think it's still true. And so, if you look in the old world, you have absolutely providers like Amazon or DigitalOcean or Google and Microsoft where you're selling computation or you're selling storage and it's about performant software. And so there's an element of that in Web3 for sure, right? Like, how do you help a developer figure out, okay, I need lots of transactions for cheap. I'll use a layer 2. I need one transaction every month, but it has to be super right. I'll use Ethereum, and I think that's there. And then the second dimension, though, like in the traditional economy, is the question about financial value. So custody of assets is kind of like the server farms for cloud computation. So if you have some gigantic mutual fund or ETF, or you have, deposits at a bank, like that money is sitting somewhere and it's custodied on your behalf. And to me, that's functionally very similar to you're writing software and you need the computation to happen somewhere on your behalf. And Web3 actually combines both of these into the same problem, which is you've got a infrastructure provision stack for this economic architecture, which is both financial and computational at the same time. And so I'm still like left wondering or confused often of like, you've got the Web3 developer platforms and they have all this stuff to let people access and write tokens and create tokens and so forth. And then in a completely different pocket of our industry, we have things like Fireblocks, right? Like institutional custodians for digital assets. Again, all API based to access the asset class and not build the software. And I guess I still struggle that these things are separate. Like, why have they not converged into the same infrastructure? That's my soapbox.
I think it's a good question. We've considered, like, how can we help custody assets, or should we get into staking, right? Should we offer this to our customers? And so far we haven't made the moves there. And I think it's a complex problem, or not even a problem, a complex opportunity that we're always thinking about. But for us, as you said at the beginning of the podcast, one step at a time for us. And so I think that's right. But right now, what are we focused on? High performance, high reliability, making sure that we can guarantee uptime and availability across all chains, which is actually really hard to do. And then ask these kind of more theoretical questions of, is this something that we should get into? And we're friends with Blockdaemon, we're friends with Figment, and trying to figure out, what do we do here? How can we help with those initiatives?
Switching tracks a little bit, let's talk about the shape of the multi-chain world. It's, for me, a difficult topic because you have to kind of balance a mental model that kind of explained the world at one point and the evolution of the industry and the ecosystem in reality, and map those two things back together. So, there's so many analogies. There are the analogies of the telecoms in the early 2000s, which had overbuilt capacity, laid too much cable, and all these telecom companies went out of business, but a few. But at the same time, there are other things like standards, the proliferation of standards that led to the creation of the internet itself, and how all of the different standards and technologies came together to create what appears to be like a single, simple experience. And then we also know the network effects, right? Like when a network accrues more users, it's usually more useful, and then it accrues more users and creates barriers to entry for others and so on. At the same time, right now in Web3, we have kind of a weird dynamic, which is that we have, I think, increasing splintering and really strong incentives for people to launch layer ones. And then after the layer ones are launched, launch layer twos. And you have different standards, you have different programming languages in which decentralized applications are built, you have different computational paradigms, and very different stories even about what the things are. So how do you think about, from the perspective of Quicknode, how do you think about a multi-chain future, and then maybe the distribution of usage across the different chains? Like, what are the lessons you're seeing across the different networks that you provide?
Yes. Just to answer the question, we do believe it's a multi-chain world. And it's not like a pure Web3 vision as one might think. I think, if we look at the market today, just zooming out, we're still on what I would call like picks and shovels, right? And so we see tax compliance tools or compliance tools for Web3. And so those are essentially needing to get all the chain data for their customers. And then any other kind of infrastructure or developer tooling is also kind of needing all this chain and multi-chain data. And so I would say what we're seeing, at least on behalf of Quicknode, is if you're a picks and shovels kind of developer tooling business that's not necessarily creating their own token or pure Web3, it is truly a multi-chain world. I think it's really interesting to see kind of these decentralized applications that are just fully on one chain. Like, is there going to be some paradigm where they're going to adopt more chains based on the certain use cases that they're going to tackle, or are they just going to stay, for example, on Solana? We see a lot of Solana-only shops, really, of course, based in the requirements of Solana, and we kind of see that throughout a lot of different chain ecosystems. But I think at least what we see at Quicknode is the multi-chain world is very much infrastructure and tooling companies providing value and tooling for other companies to better understand Web3, if that makes sense.
One last question for you that is a hard one, I think. I don't know. I haven't figured out the answer. Maybe you have it. All the Web3 tech, end of the day, is largely sitting on big tech hardware. So a lot of the mining or validation or, broadly speaking, security provided to the networks, as well as the services that help people connect into these decentralized networks and program on them, much of that is sitting in cloud, right? So it's sitting in the types of companies that you worked at before.
Those companies.
It's a dependency for sure, especially to some of the stories about the space. And then similarly, on the user experience side, on the B2C side, you've got either Apple or Android that you are putting your wallet into. And we've seen a lot of pushback from the mobile operating system companies on like what's even allowed to be an app, right? Like, are you allowed to fold commerce into it? And Apple's been very strong in preventing decentralized apps and wallets and marketplaces and so on from actually being adopted by people. So both on the hardware side and on the user experience side, this industry, our Web3 industry, is still wrapped in big tech. What's your view on that? Is that something we should be protecting against, leaning into, and what are the possible ways you think it can play out?
Oh boy, Lex, this question can get me in trouble in so many different industries and schools.
Perfect. Good.
Is it a good thing? Probably not, right? There's a lot of other infrastructure providers out there in Web3 that are just like only on AWS. No offense, Lex, but I'm pretty sure Infura is an AWS only shop, as well as a few others. And so what we've tried to do is be completely distributed. And so we're not fully decentralized, but we're scattered across various providers with active auto scaling and load balancing, just so if AWS wakes up one day and says, you know what, F Web3, and they shut down access, it really wouldn't affect us versus others. And so we're always thinking about ways that we could hedge against kind of the dilemma that you just talked about. Is it good? No, I don't think so, especially for a fully decentralized world. And I even think in the infrastructure space, the infrastructure providers who claim they're decentralized, they're really mostly just distributed amongst other platforms and providers. And so have we been able to really master full decentralization, at least on an infrastructure layer, outside of everyone hosting their own nodes in their garage? Probably not, but I think that it's probably the right move down the road. I mean, we have this discussion all the time at Quicknode is when and how should we decentralize? When will it make the most sense for our customers when performance reliability is where it is now in our distributed strategy? But I think it's a great question. It's something that a lot of operators in Web3 are consistently thinking about. And I think if you're in Web3, you're already super paranoid about the concentration in AWS, GCP, and Microsoft, and then concentration on kind of app stores and things that you mentioned. And so that paranoia is healthy, and it always pushes us to figure out, well, how do we hedge? How do we hedge that risk? How can we have a really thoughtful strategy there where kind of those risks of what can happen won't happen in this world? So that's my very politically correct answer, Lex. I hope that appeases you.
It's a great answer. And, the thing is, like, this is legitimately something I think is just really hard, because I would love to be in a world where I think it's easier for Apple to shut down Web3 than it is for the SEC. Because it's a private enterprise, it's a commercial decision and so on. It's not about freedom or rights or politics. It's just like, well, we don't want this in our store. And at the same time, like, gimmicky answers like the Solana phone or something, they're not it. So I really hope that there is some other way, although I don't think it's really been opened up, but it is definitely in the background. If our listeners want to learn more about you, get in touch, or to learn about Quicknode, where should they go?
You can go to quicknode.com and you can check out our docs. I think it's quicknode.com/docs. That really is the starting point for a lot of people, just to understand how to build on whatever chain, however you're trying to build. If it's an NFT marketplace or if it's a wallet you're trying to build from scratch, we have a lot of helpful guides for you on how to do that. I think our YouTube channel is also picking up steam, where it's just really bite-sized videos that help you understand how to build your decentralized application. For me, oh boy, I'm a nerd, Lex. I hang out behind the scenes. So I'm not at conferences, and I'm not like a super visible persona here at Quicknode, but feel free to find me on Twitter at Jackie Delaw, Delaw. And I'm happy to respond and share some things here and there. But my public persona is very much introverted compared to others at Quicknode. Maybe that's the lawyer inside me. I don't know, Lex.
Yeah, it's okay. We're all nerds here. You're safe. Jackie, thanks so much for joining us today.
Absolutely. Thanks for having me, Lex. I really enjoyed your thoughtful questions and our conversation.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.